Hello and welcome to today's ASX Investment Opportunities in Review. Any individual reading this should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. The software that I will be using today is the Investor Signals member area. If you'd like to gain access to it via a 30-day free trial, please visit our website or email me, leon@investorsignals.com. We have a special running where 12-month subscription to it's $1,320. So log on to the website and start your free trial. We'll move straight into a graph of the XJO view, sort of where the market is at relative to historical lows, and then we'll start to have a look through the stocks that we think you should be thinking about adding to your watch list and looking to identify upcoming buying opportunities in. There's not a lot of visibility in the market around what earnings look like short term, but we know that on probability we'll get through this over the next month or two, and we'll start to see some forward visibility around what earnings look like, at least into the second half of this year. We can maybe draw some confidence that China factories are reopening, people are returning back to work, and just an example of a couple of US corporations there, where Starbucks has reopened all 90 stores, Apple's reopened 34 or 40 odd stores in China. So there's a process, it appears, that we will hopefully come out sort of the other side, and some of these measures that are put in place. When we think about, I guess, China from a 10-week period from when they had sort of the peak incubation period around the virus to when people have started returning back to work. So hopefully that sets a pathway that we can see development similar to that in America, Europe and Australia. If we look at where the XJO is sitting from historical levels, we're effectively back at average market levels from 2010 to 2012. So we've given up a good 8 years of gains in the equity markets. We'd expect, if you think about past crashes in the market, most of them have found support somewhere between 30% correction and in extreme sell-offs around 50%. And if you look at the recessions over the last 100 years, those we're sitting sort of in the middle of that range. Obviously the sell-off's been far quicker than any others, probably with 87 being the exception. But we're starting to get into levels where at least half of the recessions have found support at around a 30% sell-off, and so that what seems plausible to me is that if we were to have a increase of, or a flare up in China again, and people were unable to continue working in China, that would create an environment for the equity market to have another leg down. But at the moment, I think we're probably at a point where we could start to see some buying come into equity markets, but it's clearly a very cautious environment. So if we just move forward on the index, we're back at levels, as I mentioned, from 2012. If we start to sort of have a look at individual stocks and see where are the opportunities, lessons learnt from the GFC within portfolios, you want to keep trying to shift towards quality, so cutting names that may have balance sheet risk and trying to keep exposure to the market, because you don't want to miss the recovery when it comes, but ensuring that your exposure is maybe through a basket ETF such as the ASX Top 20 or the ASX Top 50, and likewise at an international level it might be the Global 100. So trying to focus on the highest quality opportunities in the market and shift out of stocks that may be susceptible to having to cut dividends or do discounted capital raisings. Part of today's intention of the webinar is to try to sort of identify a group of maybe up to 10 stocks that you can make a note of and start to think about, where there's opportunities at individual stock level. And then I'll finish with a review of those ETFs, just for you to think about shifting portfolio exposure across to a basket of assets. So Newcrest at around $22. We've been commenting this on the blog. Gold should start to find support at the moment. Newcrest will be a beneficiary of that, so at around $22. Evolution as an alternative, but certainly Evolution within the gold space, and North Star. So there's 3 gold stocks there for you to have a think about. Probably our preference at the moment is North Star and Newcrest, but we tend to lean towards Newcrest. Crown Resorts, so we've had a number of Crowns being suspended at the moment, voluntary suspension as a Star Entertainment. So CIMIC Group, I'm just going to reorganise this watch list. So we want it in percentage gains, and we're going to have a look at the stocks that are under buy conditions. So let's just try this again. So Evolution, North Star, Flight Centre, and Sonic Healthcare. So Sonic withdrew earnings guidance, as we've started to see a number of companies do, which on an analysis, what we think is that Sonic Healthcare is probably looking at an earnings downgrade, something in the order of around 20%. Puts the stock back on about 17 times earnings. It should support a dividend yield of around 3.2%. So back here at around $20, we'd expect to see this start to find some support. So if you think about it, adding it to your watch list and identify sort of the first area of support there at around $20, it's rallied almost 10%, or it did rally 10% off today's session lows. It's given up a small amount of that in the last few hours, but Sonic Healthcare should be a company that comes out the other side of this without sort of suffering the same level of earnings miss that some of the other businesses are clearly going to. Amcor, so a little bit cautious here on Amcor, and we'd like to see this back down at maybe sub $11. So just keep an eye on that this week to see whether you see a retest of that sort of $10 to $11 price range in Amcor. I think we'll update you on the blog if we see it back down at our buy level, but that certainly makes it to our list. Cochlear, if you think about the GFC, Cochlear was one of the better performing stocks, as was CSL, Ramsay Healthcare, some of those businesses, but Cochlear is certainly one that stands out to us. So track this as it moves back down to, say, sub 150, and keep an eye on the short-term momentum indicators for it to turn positive, but we'll highlight this on the blog over the coming days as we continue to track that. Iron ore prices have held up surprisingly well at around $85 a tonne. And that's been surprising compared to other sell-offs in the market where you've seen both iron ore and oil trade lower. But in this case, iron ore's held up, as I said, better than most. If we were to see that second, wave of issues in China with the virus, I think then you get a major leg down in iron ore. So it's certainly not without a risk, although iron ore's held up well, and you've seen that in Fortescue and Rio probably doing better than most areas of the market. BHP's obviously got exposure to energy, so that explains why it's underperformed relative to Rio. So BHP, there's risks there, and we'll continue to kind of monitor the news flow in the market. Now, NIB Holdings, it's rallied back to around $5. We think that starts to run into resistance there again at the moment. Sydney Airports, again, just hard to get the visibility, and for these reasons we'd prefer to own these stocks within an overall ETF like the ASX Top 50 or the ASX 20, rather than sort of start to look too closely at too many individual stocks. Now, that's not to say that there's a handful of companies that that we're obviously focusing on, but we don't want to build out a portfolio that's too broad in this current market. Telstra looks to be finding support at around that $3 level, but we're not doing too much there at the moment. Brambles, again, not doing too much here, but I think Brambles has actually held up reasonably well in the context of sort of global trade slowing. It it was trading on a high PE going into this. It was one of the bright spots in the industrial sector, growing earnings at about 5%. It was hard, in a soft market, we could easily see Brambles break that $9 support, so it's not a stock that we're really focusing on at the moment. CSL looks to be holding up okay on this sell-off. We just look back at where that prior resistance was at around 230, and you'd have to say somewhere between sort of this 230 and 250 level, CSL should find support. So that's one that you should add to your list. Qantas, we're not doing there at the moment. GPT, not doing there. Rio, so this is sort of where we're seeing that iron ore play doing better than a number of areas in the market. The risks still sit there that if for any reason there's another flare up there in China, then iron ore, you could see, maybe pulling back 20% or so, which will have a clear impact on Rio and BHP. So again, with those names, we'd prefer just to buy the ILC, the ETF, and just have broad exposure to the ASX 20 rather than sort of trying to pick through individual stocks. Not doing there at the moment. Ramsay Health Care. So this is corrected from $80 down to around $40 to $45. Becomes our buy range. Watch the short-term momentum indicators here, and we've added this one onto our list. As I said, there's about 10 stocks that we're tracking, so just to revisit those, we've covered Newcrest, so Sonic Healthcare, Amcor, albeit we're looking for lower levels in Amcor, Cochlear we like, and we'll revisit that one on the blog, Ramsay Healthcare, which we've got up on screen at the moment, Woolworths, so we traded out of these stocks. We had bought Woolworths and Coles over the last fortnight, and we traded out of them up at their highs, and since getting out, the stocks corrected lower in both of those examples. This week probably presents another entry opportunity for Woolworths and Coles. So I think if we had another day or two of selling, maybe by sort of Wednesday, you might want to start to have a look, and that may see Woolworths back on that support level of around $32. So add that to your watch list and just make a note that's trading sort of below 35 at the moment. If you see it down around 32.50, that looks like a fairly low risk entry level, and it's probably one where we just trade out of it again. We'll be a buyer at that level, and then any rally back up towards sort of that $38 would take profit on it. Coca-Cola, so this is not one that's on my list, but I think that's one that you could just keep an eye on, back down to around $7.50, and again we'll update you on the blog if we see that transpire. Medibank Private, not doing there at present. Transurban, again, preference is just to these top 20 stocks rather than building a portfolio of 5 or 6 or 7 top 20 names. It just seems to make more sense to spread that risk out by buying the ILC, which is the ETF that tracks all 20 companies. Ansell's been hit hard, so from $33 down to $20. Not a stock that we're doing much in at the moment, but you can certainly just keep an eye on that, and we'll watch over the next week how that develops. Anything tied into freight, so your port stocks, or in this case Aurizon, the old Queensland rail business, has been hit hard. Now they were trading on a fairly high PE coming into this, are paying out 100% of their earnings in dividends, and we're likely to see significant dividend cuts in the second half of this year across the market. So we're not doing anything there in AZJ at the moment. Insurance Australia Group, we're avoiding that. Oz Minerals, again, preference, BHP, Rio. But rather than owning too many of these names, just get the exposure through an ETF for the time being, and you just want to average into something like the ILC where you're not having all your exposure up front. We don't really know how this event plays out in the markets yet, so you've got to have some cash there to average down into a basket trade like the ILC over the coming months if that's what's required. APA Group held up reasonably well. This is the gas pipeline business, so it's infrastructure. Coming into this, they were growing earnings at around 7%. It's one for us to keep an eye on as we start to see, if we get to a point where the news flow starts to turn positive, then obviously we'll start to identify a broader number of individual stocks to concentrate on. But I think at the moment, this shift is just towards quality and thinking about not holding too many names in the portfolio. ASX, beneficiary of increased transaction volume. If we have a look at the NYSE data, they had a spike of over 50% increase in trading volume on the same time last year. We should expect to see similar numbers in the ASX, so we anticipate that the earnings hold up a little bit better than most there in the ASX. Orica looked attractive coming into this. The sell-off's getting very deep here and not really doing too much there at the moment. Goodman Group, so Goodman's has low gearing levels, and they focus on logistics centres, or the large-scale online fulfilment centres for online shopping or online distribution. So they're in the right market space. They were very expensive coming into this. And it is a stock that I think you can keep an eye on, and down at around this $10 level, it's worth just tracking. And at some point, too much bad news will be priced into the market, and we really don't know how close we are to that stage. But it doesn't hurt to start to build out your list of stocks that you want to look at if we were to see that basing pattern develop sooner rather than later in the market. Goodman Group's one of those stocks. It's a high quality business, low gearing, so happy to sort of entertain a closer look at that. Coles and Woolworths, I think this is something that over the coming days you really want to track these. You're probably only 1 or 2 days of selling before we've got an entry level there in Coles and Woolworths again. Xero, so this is one that I've posted on the blog and I've added it to my list. So we got up to Ramsay Healthcare, so the next one on the list now is Xero. So somewhere around this sort of $50 to $60 level, I think it finds support. Santos, not doing there at the moment. Woolworths, we've covered that, and ASX. And I've got one more that we want to cover as I just move through these. So TPG, Cube, so some of these are starting to get into heavy levels of selling. Celtex, interesting Celtex, it's obviously a takeover offer there at $35. The market's pricing this as if the deal's not going to proceed. Whether the price gets revised lower, we'll have to wait and see. The market certainly pricing Celtex on the basis that the $35 offer is not proceeding. Origin Energy, again, high risk at the moment, so we'll come back and revisit that. If you're going to own the banks rather than be overweight 1 or 2 names, you may as well own either the MVB, which is the banking ETF, or again just if you're holding portfolio of resources and banks, you can give some thought to replacing that with an ILC, which is the top 20 ETF, rather than sort of be stuck with individual stock exposure too much. Wesfarmers not doing there at present. Fortescue, as I mentioned, held up well, which reflects iron ore staying in the mid 80s there. Aristocrat Leisure not doing there. Beach Energy not doing there. We've avoided the oil names for the moment. Lendlease, a lot of these property stocks have been hit hard in the last week, so they held up a little bit better than most, but in the last sort of week to 10 days the property names have really come under pressure. James Hardie, again, not something that we're doing much on there, but I'll just point out the reversal that it's had off that $12 level. So a deep correction from 32 down to 12. We start to see a little bit of buying come in there. The regional banks we're avoiding. So some of these to have a think about, the likes of car sales, REA Group. The risk is a little more elevated in these names, but you can at least start to have a think about sort of some of these tech names that were doing well in the lead up to this, what type of recovery we see in those businesses, 3 months out from where we are at the moment. ResMed, so keep this one on your list. I think this is something to consider down here at around $18, so it's not very. So the likes of ResMed, Cochlear, CSL, Sonic Healthcare. So generally stocks within that healthcare space are areas of the market that you want to be having a look at and thinking about. Magellan Group, nothing there at present. BlueScope, and then Cleanaway. So at around somewhere around $1.40, you might want to start having a closer look at this and tracking the short-term momentum indicators. At the moment, they're still trending lower, but down there at around 140, you're probably getting back to a level where Cleanaway starts to find some support there on a valuation basis. And that was the last stock that we've added in our list. There was Cleanaway. Car sales, keep an eye on this one. So REA and Car, two of those tech plays to have a think about. Macquarie down here at around $71, high risk. So again, maybe just the ILC and buying the top 20 stocks rather than finding, as I said, 3 or 4 of the top 20 companies that you're overweight in your portfolio. Not doing in downer at the moment. Seek's another one of those tech plays to have a think about. So probably REA and car sales sit a little bit higher on my list than Seek, but I think certainly in the basket there to have a think about. Challenger not doing there at the moment, not doing in Afterpay. And then CIMIC Group. So the story here is attractive in that they're an infrastructure business that deals with a lot of government contracts. The concern is there's only 15% of the stock on free float that's trading in the market. The Spanish parent company owns the rest. They've written off all the liabilities there in the Middle East. But these businesses seem to be notorious for surprises, but CIMIC's one that you could just keep an eye on. It's put in a pretty significant low there, a bit of a capitulation low it actually on that day traded down to a low of $11.87, so it's come back up a long way from that, from almost $8 off that low. So just keep an eye on the buying support there, and if you're doing something in CIMIC, just run tight stop losses below the recent session lows. So just to revisit that list again, let's just move through them. So we got Newcrest as an individual stock. So support there at around $22. We got Sonic Healthcare, where we think the earnings impact's going to be a little bit lower than other areas of the market, and should find support at around this $20 level. Amcor, not really one for today, but later in the week, if we see another leg down in the market, could have a look at that at around $10. But you want to be compensated for the risk there, so we want to own it at lower levels. Cochlear, let's take you back to the GFC, where Cochlear outperformed most other stocks in the market. So at around this 150, 160 level, keep a close eye on that for buying support building up. Ramsay Healthcare, so I just think this is looking cheap. So at around $48, $50 there, watch that one closely. Xero, a quality business that's on the list there at around $60. Woolworths, so ideally we'd like to pick this up a little bit cheaper than where the market's trading. But anything sort of back down around that $32.50, if we did see a little bit more selling in the market, I think that's a good buy. ASX, beneficiary of volatility in the market, so as volumes pick up, so I'd expect not to see the same downside risk here in ASX as what we've seen in other areas of the market. and clean away. Now we'll put this list together. It'll go out as an attachment on today's recording, and if you continue to read the blog throughout the week, I'll update you on the timing around the entry of some of these. Now on an ETF basis, if we just have a look at an example of this one here, the iShares ASX Top 20, the ILC. So again, if you're going to hold a portfolio which contains BHP, Rio, CBA, arguably you're better off with a basket trade like the ILC, where you're diversifying it across all top 20 companies. If the market rebounds 10 or 20%, you're not sort of stuck with one stock performing well and another not, and therefore not matching the index on the way back up. So rebalancing your portfolios towards a basket of stocks makes sense. And if you'd like to get access to the technology here and log in and review our ETF model portfolio, or have a look at sort of some of the ETFs in the platform, then just log on to investorsignals.com and collect your free and start your free trial. Or if you want to ring me at the office, happy to have a chat with you. So 1300 614 002. And just before I conclude today, let's just have a quick look at the US stocks. And I appreciate not everyone trades or has a portfolio of US stocks, but I think just given the movements in the market, what I wanted to do here is just go in and have a look at the Dow 30. We're going to arrange them by the percentage gains. We're going to get them into stocks that are under buy conditions at the moment. I'm just going to move through these quickly, but just so you can, so we're looking at the top 30 companies, the Dow 30 in the US, and we'll just move through these. So the Travelers come, Merck Group, so at around $71. Intel, so I've got a short list here of US stocks. I've got 6 names that I wanted you to just make a note of. So Intel's one that we like, and somewhere between this sort of $40 and $45 we'd be looking for Intel to build a support level. Likewise McDonald's, this one's made it onto our list, somewhere between sort of that old high there around 130 to where it's trading at the moment. Should turn out to be a good entry level long term. United Technologies got the big merger with Raytheon coming up. JP Morgan, in some ways a little bit similar to Macquarie when you're thinking about the risk profiles of the businesses, but JP Morgan, a clear leader in banking and investment banking space. Dow Inc. and they're present. Boeing, so it really puts into context there the issues facing Boeing, both with the 737 MAX and obviously issues impacting the airline industry. The US government is preparing between a $60 and $120 billion bailout package for Boeing. We don't know the exact terms of that yet. So Verizon, Visa, MasterCard, American Express have all been hit hard in the sell-off. So Microsoft makes it onto our list. So just again to recap, we've got Intel, McDonald's, Microsoft, and the original sort of breakout level, if you like, was around 115. So between 115 and where we are, 130, I'd expect to find Microsoft develops a support level. American Express under pressure. Nike, so again retail, consumer discretionary is heavy. IBM, started to see a turnaround there in IBM, thanks to the Red Hat acquisition they did. But again, the earnings picture becomes a lot more uncertain at the moment. Home Depot not there at present. Johnson Johnson not doing there. United Health Group not doing there. So Apple, like Microsoft, I think you need to add this one to your list, and I think Apple maybe between 200 and 220, 230 where it is at the moment becomes an area to have a think about. Caterpillar, not there. Goldman's, Procter Gamble. So Coca-Cola, so this one we add this to the list. So between sort of $35 and $40, we'd expect to find this company find support. It's one of the biggest holding in Warren Buffett's portfolio, Berkshire Hathaway. It's a quality business clearly, and at some point the sun will come out and people will go back to play. So Coca-Cola, think about that one. 3M company, not there at present, and then Disney. So this is the last one that I wanted to finish on in the US. So have a think about this at around sort of this $70 to $80. I'm sure if we go 6 months out, there will be a day when the parks reopen. They've got all the Fox media assets. They're creating competitive service to Netflix. We may look back in a year or 2 years' time and recognise that $60, $70, $80 for Walt Disney was a good entry price. So just a recap on these US stocks. So make a note of them. Intel, we like that. McDonald's, Microsoft, Apple, Coca-Cola, and then Disney. So to go in there and have a look at these, you're just going to go to your watch list and you're going to go down and select Dow Jones 30 and toggle through those. Thank you for listening in, and if you'd like to know more about the technology, please give us a call and we'll help you get up and running with your free trial.